Here we go. The live stream is on, and we are about to start our podcast. Just a second. All right. Hello, everybody. We have another podcast at Go Global World, the community for entrepreneurs who are building international companies and plan to go global. And today we are going to discuss exit strategy. This is a kind of topic every entrepreneur is dreaming to learn and to have this on their achievements. However, not every entrepreneur achieved to have at least one exit. Here with me today, an expert and serial entrepreneur who've done over 15 exits in his life and impacted many startups around the world, Peter Warnoe. Hello, Peter. Good to have you from Copenhagen, Denmark.
Thank you very much for inviting me.
Thank you. So Peter is the founding partner of Nordic Eye Venture Capital and an experienced technology investor and C-level executive with more than 25 years of experience leading many companies and helping many startups. What really inspires me about Peter that he's done so many exits, and so not every entrepreneur could achieve. And this is the exactly experience we would like to learn from. At the same time, an interesting part of Peter, and he has many angles of his personality, but as an entrepreneur, he also had involvement in Shark Tank. And he is one of those investors who goes on a demo day of Y Combinator and pre-select startups for potential investments. So, Peter, I'm really excited to have you here. And please give a little bit of introduction of yourself, and then I'll just won't wait much and ask you to get to the topic.
Okay, thank you for inviting me, Daniel. Always a pleasure when people want to hear what you have been doing. In general, I'm an entrepreneur. When I was 23, 24, I started my own business. This is more than 30 years ago, as you can see on my gray hair. My first business I brought to 400 employees, 150 million euro revenue, and I sold it in 97. Then I did a huge roll-up with CVC Capital in London, where we
That's impressive.
Where we acquired 65 companies in 2 years in 12 countries with 200 employees. It's another way of building a business. Instead of
did I hear correctly? 65 countries in 2 years.
Yes.
Wow, that's a lot.
Yes, we did a lot of M&A, and it's like being Alex Ferguson or Jose Mourinho. When you're a football team, you buy the best players and you try and create a team out of it. Anyway, I have been investing personally in many different companies. And then as another startup 4.5 years ago, I did Nordic Eye Venture Capital because instead of investing my own money, I thought it would be very interesting with the experience I have from also Shark Tank, from being on the board of the Danish Prime Minister, Digital Advice, and also on the Export Council of the country, to invest on a sort of higher level. So we formed Nordic Eye Venture Capital, which is a company with almost €1 billion under management now. We have around 40 investments in US and in Europe, northern part of Europe, obviously, and many places around in the US. So today, I am the founder of that company. So basically, founding a venture company is like founding any other company. The only issue that we need money to invest. So I'm doing just as much fundraising as everyone else, maybe even more, for my fund. And I work obviously with very successful founders in their different companies in North of Europe and US. So that's basically my background. And I'm based here in Copenhagen, but I travel almost every week. Tomorrow I'm going to London. Last week I was in New York. So I basically, especially now when COVID is a little bit less, at least in terms of traveling. I'm sort of all over the place, mainly US and Northern Europe. So that's my background.
That's exciting. I mean, this is such an experience remarkable for every entrepreneur, and I'm glad to have you with us today. We also focus a lot on helping entrepreneurs entering the US market, as probably this is among the largest markets entrepreneurs should go after. And so on our podcast, there will be many entrepreneurs from different parts of the world, but most of them are targeting primarily the United States as the entry point for the rest of the world. And so coming now back to the topic that we have today, exit strategy.
Yes.
So building a successful exit strategy for startups. But before we go into this, what is an exit strategy? Why is it important for startups to plan early?
I mean, first of all, I think there's many different exit strategies, and there's also many ways of driving a business and getting a good financial return out of it. You can also have a very good profitable business and keeping it for many years, and every year receive some return, some dividend, which of course obviously also could be very successful. So I think it's not only about starting a business and selling it and receiving a lot of cash. It's a little bit more. There's a lot of more to it than doing that. I think also there's a balance, because even though you obviously as an entrepreneur often think of the big exit as the goal for your business, I think also running the business on a day-to-day basis for many, many years, you really need to focus on that and obviously not have any thoughts on the potential exit, particularly in the beginning, because it comes as it goes. But I think, having said that, also as a venture fund, we look at obviously many companies every year. I think over the last 5 years, we've looked at more than 1,200 companies. And if we look at statistics, it's very clear that the most successful founders are the one who has a very focused economic or financial goal with driving their business. So either we like it or not, the most successful entrepreneurs are typically the ones who also drives it towards an exit or towards creating a huge financial return for him or herself. So as a venture fund, we obviously look at what is the strategy for that. We do not like to invest in companies where the founders are not focused on that. And that is basically what all investors are saying. They're not in it for life. They're in it for a certain time of year. So I think one of the first lessons learned when you take investors on board is to make sure that you are in line with a potential exit, or at least you are in line with what the expectations are from the investor side. Do they have a 2 years scope? Do they have 10 years? Do they have 5 years? I don't know. But at least I'm sure any external investor always look at some kind of exit. So as soon as you decide to take someone in, you also need to have some thoughts about your exit. And when it's supposed to come, and how big does it have to be, etc., and when is the right timing. Going back to the actual scenario, I think depending on your business, obviously, I think the first couple of years, 2-3 years, typically, you do not have a lot of focus on your exit. You need to build up your business. You need to hire people, finish your product, get scaling, etc., get financing. So you basically do not have enough time to think of what is the potential exits. Even though you are being asked from the first investor coming on board, who are you going to sell this business to, at what amount, and when? Those are the three questions that pops up immediately from any investor. So it will be part of it, but I don't think on a day-to-day basis. Having said that, I think also a business should always be ready for a sale. Today, M&A is a huge part of the market. You've never seen so many M&A activities as you do right now. In some places, you see great IPOs also. So in general, with all the new growth companies coming up, a lot of people will also buy companies, and you can obviously also do IPOs or many different ways. So I think it's important that you always keep in mind that what if somebody showed up tomorrow and said, I would like to buy your business? Then I think it's important that this is not a big surprise, meaning that you need to have your business ready for a buyer. You should always keep your business ready for a potential buyer, meaning that you should very quickly have a board. You should have the structure in place. You should have thought of the tax implementation on a potential exit. You should have any contracts in place related to the cap table, who's on the cap table, who's expecting what, who's getting what, etc., etc. It's a long list of things. Plus, of course, your whole structure in terms of your financing, your administration should be in place, because a exit scenario or an exit process could be quite time consuming. So it could take 3 to 6 months, could even take 12 months. So always keep your business at a certain level, ready for a potential buyer. I think that's important, that you make things ready. And there's different things that could be ready above, except the ones I mentioned now. For instance, my business here in Nordic Eye, I think most people would look at Nordic Eye and say, how much is the business worth without me on board? So that's probably one of the things I need to work on in Nordic Eye if I were to look at an exit over the next years or increase the value of the business. That would be making sure that I'm being diluted as a person. So whenever someone buy Nordic Eye, they would not be completely dependent on me, which you obviously are in the beginning in an entrepreneur company. You are obviously quite dependent on the founder. So make sure you hire someone, make sure that all the revenue from customers are not on one person, etc., etc. Again, things that make your value increase and make potential buyers be more interested in your business. So those are some of the issues that are important, I think. I think also another advice I would give to founders would be maybe get your board or get someone external to negotiate. It is a bit like selling your house. You've lived there, you've enjoyed a lot of moments there. So obviously your expectations are quite high because you believe this house is beautiful. And you get a little bit disappointed when someone offers you 20, 30, 40% less for your house. I think therefore you negotiate with your heart and not with your brain always, because obviously your business has taken a lot of your time and risk over the last 5-10 years, and you have a certain idea of what the value is. So I think in terms of the negotiations and process and dialogue, you should either have advisors on board, or you should have a mentor or friend or whatever helping you out to face the dialogue you have. And always remember, the buyer is always just as interested as you are, or maybe even more. And he or she is actually also very human, which means that it's not always black and white when you negotiate these things. And there is time for good chemistry and whatever is needed to get the deal in place. So I think that hiring advisors, I would in any case, whenever you start a business or you bring up a business, very quickly make sure I get some kind of board that helps me out, even this business is very small. And that board obviously could also help out on the exit strategy.
How would you set up a board that would help an entrepreneur to get to the exit strategies the right way? So, like, what could be your recommendations on setting up a board?
Obviously, you don't have typically in the beginning so much money, so you can't really pay people for go on your board. You need to give them some option or warrants or incentives to drive the business. I think you should not overkill this. So I think having 1 or 2 board members in the beginning would be sufficient. And obviously, I would choose someone from the outside, not family, not too close friends, someone who is willing to spend time on this and who believes in your project or in your company, obviously, and in yourself. And also someone you can play ball with, meaning that you can be very straight, you can be very open. I wouldn't say 24/7, but sometimes in distressed periods where you need to have someone who can help you out. And I would also to do things in a good way and to get used to work with the board, I would do it quite quickly. As soon as you start getting revenue or you start having a business plan, when you're at business plan level, it might be too early, but I would definitely hire someone and help them out. In terms of the exit, of course, it's difficult to get someone who can do everything. So you need to decide, do I need a product specialist? Do I need a marketing specialist? Do I need an exit specialist? You can always buy your way using advisors, bankers, lawyers, auditors to help you on the exit strategy. So I wouldn't say you need an exit specialist on your board. I wouldn't do that, not immediately. Unless it's an entrepreneur who's also done an exit, then obviously it comes without saying, I was about to say.
But you can set up a board that would be an interesting asset for the company, when they acquired by the other company, for example, right? So the reputation, expertise of those people may lead to a successful acquisition, for example, right?
Yes, obviously a board is important, and if you can get some good names, as we say, I think it's an extra plus. Bearing in mind that sometimes they are expensive and sometimes they're a little bit spoiled. They do not like to do the hard work. So I think it's a balance in getting the right people on board. But it's all about chemistry and whether they believe in you. If you can get someone who also puts money in, then it's even better, obviously. Then they would be part of it.
Mm-hmm. What is the optimal way to compensate people on the board, in your opinion? Because this is they are not your employees; they are like board members. Yeah.
Obviously, they need some incentive. If you have a warrant program, you give them a piece of that. If you can give them, if you can afford, if your operation can afford paying them, let's say 5,000 pounds, 5,000 euros per year, then do it, because then you have the formality in place. But some can go for free. Some I think everyone would like some kind of incentive. So I think the warrant program for employees, you can also implement that for the board. And if there's a dialogue with a potential buyer, you can always put an extra warrant or an extra earn out if this board member is successful enough to sell your business at a high price. Why not?
Yeah. And why would they be on the board at no compensation? So you mean for free? What would be their primary motivation, in your opinion?
I mean, their motivation is if they can learn something from you. For some people, it might be sort of a little bit prestige to be on a board with the right people. If you're successful, they are very, very proud, I would say. Obviously, if they really believe in your company and what you do, they can make money out of it, which is the ultimate. And sometimes people also like to connect with the right people, meaning if I mean, we all want to develop. So I mean, I wouldn't mind sitting on the board with Richard Branson and Bill Gates, because I'm sure I could learn something from Bill Gates and Richard Branson. I haven't had the chance though, but I think the people around, most of the things we do are people business. So if you get one well-known or very experienced board member on board, you can use that to get other good members on board, because we all want to work with the right people. I mean, if I did an investment and Bill Gates also did an investment, I would probably mention that to my investor board, that Bill Gates has also invested. So this is a very safe investment because he's in it. So, and that's the same with board members. It's like they really like to come if there's other board members who they know, who they're familiar with, who they trust.
Would you recommend startups at pre-seed stage to plan for exit strategy since they start the company?
No, but I mean, as I said earlier on, as soon as you take on an investor, you would need to relate to the exit, because they would ask you, when are you going to exit and to whom? Most people would say, okay, looks like a great company. Who would buy it? Who do you think will buy it? And when would that be? Would it be in 5 years or 10 years? What do you think? Because
yeah, go ahead.
So you need to relate to it somehow. I don't think you need to do an exit strategy at all, but I think you need to have it on top of your head. Who could this? How could we benefit from the investment we do? And remember, the investor, if he brings 100 euro on board, he obviously would like 3, 4, 5, 6, maybe even more 100 back. And he has a time limit. So you can ask him as well, what is your time limit? When do you want your money back?
Okay, and what are the expectations of the investors from the exit? You mentioned the money back. You mentioned some numbers, so maybe 5, 10x. It depends on the country. What else would they expect from the exit?
The founder, I mean, obviously the founder, I think, enter a new time, a new period in his life, his or her life, because a lot of recognition comes when you do an exit. A lot of new doors open when you do an exit. It's not only receiving some cash on your bank account. It could be two things. First of all, you might have a new job, meaning that obviously the buyer would like to have you still on the job or do other things or whatever. So you typically change some in your job, which you need to understand. But it could be a bigger job. It could be a different job. And if you like challenges, it's fantastic. I mean, my first business I sold to a Norwegian company, and they told me, you will be ahead of Denmark and we're going to buy another 6 companies. So I thought, fantastic. I didn't have experience with M&A, so why not? I can have a great time. I've made a lot of money for my exit. I have a job with a great salary. And now I can even practice M&A by buying a lot of companies, not risking my own money. Fantastic. It's a win-win situation. So that was great. And then on top of that, I had CVC Capital Partners. I had equity firms, I had other entrepreneurs, I had the Danish Prime Minister calling me saying, I would like you on the digital advice because you've done a great exit. You really know what this is all about. So I think it's definitely the cream on the ice cream, so to speak.
I love it.
Yeah. By doing your exit, it's what everyone is looking for. So whenever you have achieved it, you have done it. It's like running a marathon, you know. Most people can do 20 kilometers or 25 and 30, but getting over the hill to 42 and a half or whatever it is, I've only done it once in New York. But anyway, I think it's really proves that you can create something, you can create return, and then you can even get cash out of it. So that opens doors for you in terms of your reputation, in terms of people wanting your knowledge, your experience in different things. So that comes also. I think that's also to be considered doing an exit. You really enter a new world of successful founders. And you can obviously be very, very successful without a exit, but we all know that big exit is the cream on the cake or whatever it's called.
I like the way you put it, like the cream on the ice cream, and I would put some sprinkles on top, just because they get into like a new some kind of circles of network that they had no or limited chance to get into, and they are recognizing those network. That's a good way to understand it. But in terms of major failures with exit strategies, what are the common mistakes the founders do when they approaching exit strategy or building exit strategies?
The most common mistake is when a buyer approach you, you forget to run your business. You simply forget it because you are so focused on the amount of money he's offering you. You are so focused on the process, so you forget running your business. And if the buyer finally before signing decides not to go ahead, you're left in a mess. That's really the scary part, because it takes a lot of attention and it takes a lot of mind setting, and many people are involved.
Is it common to happen?
It happens, yes. It happens a lot. If people want to buy a business and they get so focused on the amount they are just about to receive, so they simply forget that you need to get up every morning and do your work as usual. It's not because people do not work. It's just because their focus has changed to the exit from running the business. And that is really a catastrophe way of doing it. And that's one of the reasons why I always say, keep your advisor in the loop, keep the advisor run the dialogue, the process with the buyer, so you can focus on your business, because you never know if the business is sold before the money is in the bank. Until last day, I experienced that myself. 2 days before signing, they suddenly said, sorry, we are out. So that's why if you have focused on a lot of other things and the revenue is not coming in, people have left the business, I don't know, many different things happened, then it's really not a good idea. So that, I think, is the biggest mistake. That is definitely that you keep forgetting your business in this whole process. And obviously, let's be honest, if someone comes to you and offer you a lot of money, you get a little bit surprised, you get a little bit high. Suddenly the dream is there. And I mean, you have a lot of, not a lot, but some people in your stratosphere also get involved. Maybe you've worked very, very hard for 10 years. Your wife has been looking at you doing 80 hours a week, 24/7, weekends, and suddenly someone is there with a big checkbook And she sees that, wow, now we can finally stop working so much. I can finally get my house, my car, my whatever. And it's going to happen in 3 months. Maybe it's not going to happen in 3 months, because maybe for strategic reasons, for political reasons, for technical reasons, the contract or the acquisition doesn't happen, which happens a lot. Not a lot, but sometimes. So then you are left with a very disappointed wife, and with, you know, a lot of time.
It's even worse. You don't have a check and a very disappointed wife. Oh my God!
Happy life, happy wife. You know that. Happy
Exactly.
life, happy life. And I actually remember once I was in Spain. I was doing one of these 65 acquisitions, and I was in Spain. And suddenly we were doing an acquisition and with CVC Capital Partners, and something happened. It was actually 9/11, and we couldn't go through. And the guy selling was so angry. The wives have already bought the fur coats. They were all walking around and with a Rolex watch, but we didn't sign the agreement, so we had to leave it. I mean, I was almost killed. Even it was still a month to go. So
what happened to that guy afterwards? Did he continue his business successfully?
Yeah, he continued his business. So all was good, but we had a couple of dramatic days, I would say.
That's an interesting view from your angle, and this is probably a good learning for entrepreneurs, because this is where they already have everything, and it's just one more step forward, and you just fail completely because of some mistakes you did. What are the good exit strategies for European and US venture capital investors, in your opinion, like the best ones?
The best exit strategies? It's very difficult to say, because it all depends on the business. What business you are in, what industry, how old are you, what are your ambitions. I mean, my first exit I did when I was about 31. And one of the reasons why I did it was because I could be part of a public company, top executive, doing M&A. I really wanted to see if I could get a lot of experience with M&A. So I thought also the job I got was very, very interesting. I would suddenly receive a normal paycheck every month, and I could learn a lot being only 32 years old. So I think and that was one of my reasons for selling. So I think it's difficult to say what is the right way, because it could be so many different ways today you can exit. I mean, obviously cash is king. Some people say no, it's not even king, it's God. But receiving shares in a company like a share swap could also be very, very interesting, because I mean, you could end up having 2 or 3 times more for your company. If you believe in the new company, you can have end up having 2-3 times the exit value if the buyer's shares go up. So I mean, I think that could be interesting, or a combination. I think one good advice would be, obviously you would be working for someone else suddenly, and for some people that is a big change, because they're used to be on their own, they're used to make own decisions, no politics, no nothing. Suddenly you are part of a big operation. You need to do their processes, you need to do things their way. So don't make too long contracts. In a maximum 2 years I would do, because you never know if the chemistry is there, if it works out, etc., etc. So that's one lesson learned, and not one advice for me, I would say. get to know them well, get to understand what is the goal of you being employed there, what do they expect, and make sure that these expectations are met and you are aligned on them. That I think is important.
You mentioned so many things already, but I will have to repeat this because this question creates some structure in terms of entrepreneurs planning and exit strategy. So my question is, must-dos, what they must do prior building the strategy, during the execution, and after the exit. So you already mentioned some of the stuff, but what would you be? Can you summarize on that?
I would definitely have some thoughts on the exit, but it's part of also the value building in the company. One of the reasons you bring a board on is also, and why you bring in an external investor on board, is that they sometimes help you create value. Make sure you make the right decisions, you do the right things to create value. Remember, the investor is there only for the value. He's not there for your blue eye. So I would very quickly discuss the value building in your business, which obviously ends with an exit. So have a piece of paper. Whenever you do your strategy every year, have in mind how does your business look by always being ready for a sale? Meaning if somebody shows up tomorrow morning, and timing is normally always very bad when these exit dialogue starts. It's never the right timing. It's just like when you meet your girlfriend. It's never the right timing. You just went out of another relationship or whatever. So timing is that you should always, when someone approaches you, have a list or have a small piece of paper explaining about the business, structuring things, so this potential buyer very easily can get access and make you an offer or leave because he can see what he was potentially buying is not what he's looking for. So nobody's wasting their time. So I think prepare that, and like you have a sales strategy, you can also have an exit strategy, sales strategy, a product strategy, whatever strategy. You could obviously also have an exit strategy. The exit strategy, however, you don't discuss with everyone. You discuss it with only the board or only with the other shareholders, and not too often.
Why, and why is that? Why wouldn't you disclose it on your potential pitch or somewhere?
Because in general, people would like to know where they are. And some people get nervous, get insecure, because obviously if you are in a huge business and the biggest competitor takes over, then you could end up not having a job. And you don't want anyone to walk around with that fear, especially if that fear is for no reason. So in general, people do not like too many changes, just like that, or the unknown. And of course, the unknown is if you present exit strategies to your employees, then they start thinking. And most of them should be spending their time in the business operation, not on whether the founder makes a lot of money, or even if they have shares themselves make a lot of money. That's really not very productive. So those kind of dialogues you keep very, very tight to yourself and a very, very few others, not to start people wondering or thinking. And, you know, if you have, let's say you have 10 people who has shares, warrants in your business, I'm sure they all have each view on an exit. Everyone. Somebody needs the money right now. He loves you to do it immediately. Somebody do not need the money at all because he just inherited a lot of money. So, and you don't want those dialogues. It's not very constructive at all. So you keep it very, very tight.
That's an interesting one. And this question I should have asked in the beginning more precisely, but what are the most common exit strategies, You mentioned already IPO, you mentioned M&A. What else would you put on the list?
I mean, obviously, trade sale or M&A is the most obvious. An IP could be another one, IPO, but there's a part-time exit. I mean, you could sell 50% to a private equity fund, and then you do an exit, receive some money, and then 3 years after you do another exit, selling the rest on a much, much higher level. So that's kind of a part-time trade sale, and then a trade sale 3 years after. The IPO is obviously also with the lockup period. But those are I would say the most common way. But another one could also be a merger. I mean, if you own 100% of a business and someone else own 100%, you could just swap shares. It's a kind of an exit, and it doesn't give you cash maybe, but it does give you an exit because your business is being sold and you swap your shares to someone. So there's many ways you can believe that this can be good. Maybe the shares are more liquid than yours. One of the things you also need to be careful about, that's earnouts. I think earnout is very difficult because obviously the buyer sometimes change the business. That's the reason why he buys it. He wants synergies. He wants to do it in a different way. And that means the earnout that you're supposed to have doesn't go through because suddenly things have changed. So you can't reach whatever revenue you're supposed to or earnings because he wants to do something different and he's not so busy. So obviously a lot of times these earnouts end up in a dispute where you thought you met your target, you didn't, and you think it's the buyer's problem, he thinks it's your problem, and he doesn't want to pay. And it's not a very good conflict if you're still working in the business. So earnouts should be very, very specific. They should be described very, very carefully, and you should know how much you can consider getting them or not. Because I think it's really something that can get people into big discussions.
Yeah, and I get it creates some conflicts of interest in the end of the day. How would you recommend to scout for companies to offer you M&A? So to find M&A potential buyers for startups?
I would speak to a banker. I would speak to an advisor in the industry who definitely knows this, who can identify the buyers. I don't think you should go out and approach them yourself. I think that would be wrong.
So unless they approach you themselves, you should go to the third party, such as a banker. Any other parties like a banker could help you with that?
Yes.
The founder?
Yeah, it's like selling a house. You go to a real estate broker, or you can go to a banker telling, I want to sell my business. What can you do? Can you help me out? He would look at who's the potential buyer, who's this, etc., etc. Many different things. And
what would be your advice on legal and negotiations? You mentioned a little bit on the negotiation part. However, there are typical mistakes founder would do an exit because they don't have much experience as a banker or as the M&A company. What would be the typical mistakes they are doing during legal preparation and negotiations?
First of all, I think always get always have the right advisors, the right bankers, it's really, really important. You should not save money on advisor. Make sure you have chemistry with the guy and make sure he's tried this before. I wouldn't cut cost on the right advisor. I know they can charge you a lot, but I think you should really focus on getting the best advisor, because he can make a lot of money.
what makes it a best advisor versus a bad one? So experience of doing it before, I guess this is one of the main.
And someone with chemistry, someone in the industry also.
Also probably they should be weighted by other entrepreneurs. So
ask for a reference list. How many exits have you done? How many M&A contracts have you done? Very simple.
Interesting. So, Peter, we had an amazing talk, and I think I've gathered a lot of practical information for entrepreneurs. Is there anything else would you like to share with our community members from around the world so they can maybe get your final recommendations about the exit strategy?
No, just I would say my final words would be, it's such a relief when you've done an exit, because it's really proving what you have done is fantastically. In your stomach, it feels great. It's not only about the money at all. It's also about the satisfaction of creating something, and suddenly other people value that by paying a lot of money for that. It's such a relief, and making people investing in your business happy with a great return. It's a great feeling. So I think any entrepreneur listening to this, put it on your strategy, work with your exit strategy, and keep it in your pocket, and suddenly someone would show up and ask for a price. Don't always have a price ready or a range ready so you can have that talk. So that's my final words.
Thank you so much, Peter.
Okay,
and to me, that was a very detailed conversation. And I would like to announce for the audience that Peter and I are planning to do a webinar on some other topic that we will announce soon on Go Global World community, and everyone will be able to register at that webinar. So just stay tuned, and you'll be notified soon on our community. In the meantime, if you have any questions, please write your comments in the chat on YouTube channel. And if there would be some good question, we will pass it to Peter. And if Peter would find time, he will give you an answer. Right now, I think this is time to finish our talk. I wish you a great journey to London. As you mentioned, you're traveling soon. And thank you so much.